elevation. Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
What's going on, YouTube? Welcome back to Goofy Investing, where we talk about investing in the stock market. This is the underground. It still is the underground. Not too much of a big channel. Little channel, big value, okay? We're going to be talking about stock analysis. We're going to be doing a stock analysis here on a requested purchase ticker, CGEH, all right? Capstone Green Energy Holdings. Trades on the over-the-counter market, $4.38. Market cap is $84.30 million. Disclosure, I'll pull up my portfolio. I do not own shares of this equity. So you're getting a non-biased opinion and so forth. This blanked out position is actually my current play. Quick plug for my Patreon before we get started, all right? Unveil the play, all right? $9.99 a month. I canceled the free trial per my guidance that at the end of November I'd be doing it. There's 10 seats remaining for that actual tier before that tier is grandfathered, and a new higher paying premium tier will go up on there. So thank you for that. If you wanna benefit off a great community, dramatically increase your knowledge and development as an investor, and be closer to me and so forth, and learn how to actually do this and multi-bag dramatically, check out the Patreon. All right, going back to it. All right, where is this company and what does it do? Well, it's a green energy play, obviously, in the title. They're headquartered in California, Van Nuys, and they have 3 different segments within their product offering. All right, we'll go to their investor slide deck, and within these 3 segments, they have microturbine product and accessories, parts and services, and rentals. All right. Their main offering is really the microturbine product and accessories. We'll go down here on their slide deck. I'll show you what they look like. And what do you know? There they are. Here's the microturbine product suite. You got the small one going all the way up to the big one. All right. And these microturbine product suites have 4 different avenues of TAM. Excuse me. All right. They could be, the TAM that this company can execute with those product offerings is in data centers, microgrids, ports and terminals, station power, etc. I assess that investors investing in this company right now are most concerned about data centers, or most interested in data centers. This company has yet to land a big partnership, and that's what makes this opportunity exciting. We're going to go over some financials. We'll talk about that opportunity, and I'll talk about how I assess the actual investment, all right, at the end. So stick around. All right. So going straight to financial analysis, we'll look at the 10K afterwards. 6.98 million in cash, 41.86 million in debt. I assess this is a highly levered company. With the market cap of 84.30 million and debt of 41 million, it's a little below half the company is in debt. All right. Enterprise value is 151.22 million. So guys, here's how you got to look at this. If you're buying the stock, the market cap is what it's trading for. The enterprise value is what comes with what you buy. So if the company has more cash than debt, it'll be subtracted from the market cap, and then the enterprise value be cheaper, so it becomes a cheaper company. The inverse is true too. When you buy this company, you're buying the debt. When you're buying the cash, okay, and everything that comes with it, including all the baggage. All right, let's talk about some of this baggage. We're going to go to their 10K. All right. Had a bankruptcy. All right. And there was a restructuring deal. Long story short, Goldman Sachs owns 37.5% of this equity. All right. And Goldman Sachs is servicing their debt. I mean, this is a lot of, pretty much most, if not all of that actual debt right here is all Goldman Sachs. They own a portion. This company is owned by an investment bank. Goldman Sachs want to hold my racks. All right. And I think that as a potential shareholder, I mean, you're going to have to be dealing with that. And there's a lot of bad things you're going to have to be dealing with on the equity side of holding this equity. Let's talk about some of that baggage. All right. Maturities. Maturities are coming due. In fact, exit maturity on the first tranche here. There's an actual maturity portion here happening at the end of this month. All right. And we're going off fiscal years. All right. So, um, and that was talked about in the earnings call. All right. I mean, 8 million is coming due. All right. Now, with that, the bright side about this is I don't believe they're going to go bankrupt. I don't think Goldman is going to allow this company to go bankrupt when they own the equity. So that's the bright side, and something to consider when you're looking at this stock. All right. That they have a partner that has deep pockets, which is Goldman Sachs, which is holding a lot of people's racks. Okay. But joking aside, we'll go back to their financial statement on the income statement. Revenues slightly going up from 10 years ago. And given the earnings call, which I assess was pretty good, uh, they're pretty much selling that they're in a transitionary period where they're going to start experiencing growth in sales of this company. They do have a interim CFO right now, so there is some leadership changeover. John Miller is the interim CFO and independent director. What is an interim CFO? Okay, so an interim CFO is someone who fills the CFO position temporarily while the company is trying to find the actual permanent CFO to come into that role. So interim is interchangeable with interim CEO, all the different positions. And typically an interim CFO is more of a high level manager that maybe worked under that position that they're serving interim to. So John Miller, which is the interim CFO, was probably working under the CFO that left. Okay. And he's temporarily filling it until the company hires a permanent CFO. Earnings went fine. I think the way that they're managing this company is okay. I don't think that they're doing a bad job, but I'm not necessarily convinced they're doing a good job either. All right. So take it for what it is. That's just my opinion, my humble opinion here. Um, I think that what they're trying to sell is, hey, the past is the past. We're going to start focusing on creating shareholder value through growth of sales. All right. And they got a long way of growth ahead of them. This new, how do you say, these micro turbines, all right, going back to it, they're, they have the opportunity to deploy these products, and they've postured to this 800 VDC, HVDC target 800 VDC, if you will. And that 800, they've pretty much grew it. They had a 760 output. Now they're at an 800 output. What is the importance of that? Well, a lot of data center requirements, they need 800. That's the output and input that they need. Okay. And Nvidia growing all these data centers and etc., and these bigger companies that are involved in this data center build out are looking for more clean energy to get cooler units running through those data centers, because it gets really hot up in there. All right. And they have to make sure those chips don't overheat and etc., and these products really help that. All right. So there is no major partnership yet. Once again, if you're in this stock, a lot of the investors, they're looking for that potential partnerships to come from somewhere from a bigger player, which can be huge for a very small company like this. If a company with just even a 50 billion market cap, 150 billion market cap comes in and partners with these guys, can mean and do well for the stock, all right, for the actual owners of the equity. So these different segments, all right, let's talk about the other side: parts, services, and rentals. Rentals are self-explanatory, all right, but they're parts and services. They do have some ISS, they do have some IP out there. There are some little widgets that they have created, that help cool or heat or what have you, change some temperatures and more efficiency within the inverter turbines, whatever. But nothing, all in all, nothing crazy or life changing in their IP is what I've seen. Okay. So there's that to consider. Their parts and services has seen decline. Okay. So from 15.8 to 7.9. So fiscal year, pretty much parts and services has been cut in half. All right. Not really, that's not really that good. All right. We'll go to their actual statement. Net income. One thing I've noticed is there's preferred share dividends. I've talked about this in the past on my channel. 18.2 million paid out against the net income, of the stock to the preferred shareholder, which is Goldman. So this 18.2 mil went to Goldman this year. They own 37%. Let's do the math. All right, guys. I'll pull up my handy dandy calculator in tradition, in keeping with fine traditions. If the company is trading at 84.30 and Goldman owns 37% of the company, 31.19 million equity stake is what Goldman's stock is worth of this equity. They just paid out, what was that in preferred dividends? 18.2, 12.99. We'll go back to the actual 10K. And might I add, I've already checked the accounting and auditing and stuff. PCAOB regulated, everything checks out there, so good to go. All right. Now going back to 37.5% of equity and the actual debt maturity schedule right here. They have, and these are fiscal years is what I'm tracking. So 2027, another year right off the bat, there's going to be another maturity wall of 24.351 million. This is crazy. All right. So not only is this company owned a portion majority stakeholder of, Goldman, they're getting preferred shares spit out like crazy. The maturities are, Goldman is going to recoup their investment real fast. Okay. 8 million. We'll round it. We'll do a rounding error. So there is 7.9. Okay. Or actually, no. 12.9 minus 8. 4.91 million. So they're another preferred share dividend, and the Goldman's already profitable off this equity. It's going to hurt the stock. These maturity walls are going to hurt the stock. But at the same time, looking at this, Goldman is not going to let this equity go bankrupt at the same time. All right. So, especially if sales are going to start growing, which stock is up. All right. We'll go back to the actual chart. Year to date, it's 10x. Do I think they deserve to 10x? Maybe, maybe not. It depends. But they have shown growth and improvement on the top line. So Goldman is probably going to let them roll the notes, and they'll probably maybe charge more interest. Maybe they'll get a little bit, maybe they'll require them to put a couple million down or whatever. All right. That's going to be between Capstone and Goldman, which is the controlling subsidiary or whatever. All right. So with these preferred share dividends, it's charged against the net income. So on the actual statement below, which is the net income to common, to the common shareholder on the extra items. So really the pure net income to the actual shareholder on these shares, which are not the preferred shareholders, is 20.9 million negative. Okay. So that's something to consider. So a little bit of deception here. You have to know how to read the accounting. All right. Let's look at some balance sheet analysis. All right. So I'm just going to maximize this or extend this screen out, and we'll go 10 years out. Cash and cash equivalents went from 11.7 to 7 million over the course of a decade. That's bad. Cash is pretty much, cut down dramatically, 40% or whatever. We'll go down to their debt. All right. I'm looking for total debt more at the bottom right here. Company started with 9.9 million in debt and pretty much has 5x here to 41.9 million. So debt has shot up. So not really a good look, all right? With cash going down, debt going up, not really, not the hot tip. Recipe for bankruptcy, which has happened, all right? So can they turn it around? Well, they can. All right. It's going to be up to the management team to, I think, a new CFO that knows what he's doing to manage the accounting more properly is a must. If you get a CFO in there that doesn't know what they're doing, then this can be bad news. Okay. So what do I think about this? All right. Well, look at ownership. There has been some insider buying here at the $2 level. All right. From several officers. Very bullish sign. But a lot of their majority stakes are, not in the millions or anything crazy. This is a new, more of a smaller venture, if you will, smaller company. All right. Remember, there's only 100 people, a little over 100 people in there. Okay. Um, what do I think about the investment? Me personally, deal breaker to me with the whole Goldman situation, and those debt maturity walls and the constant rolling of debt with higher interest rates. And they can, their Cgeh, the management, they got no leverage on negotiating the rolling of these deals on these debts. They're really at the mercy of Goldman, and Goldman's got the advantage at the negotiation table. So what do I think is going to happen? All right. I think equity is going to have, there's going to be a dilutionary raise. All right. I wonder if they have, they've already, this is another private placement. So I think there's going to be another one on top. There's going to be more dilution hitting this equity because Goldman is going to say, you know what? We should issue shares. And you know what? We have a department right here on the third floor of the Goldman Sachs headquarters, and we'll charge you a little fee to issue out shares and so forth to sell it on the open market through our investment bankers. And with that, we'll own the equity, and sure, we're diluting ourselves, but at the same time, at the actual valuation we got in here, the stock is, pretty much 10x, whatever. All right. So we're good to go. Let's issue out some shares. Not our problem. We got our preferred share dividends. We're going to maintain our stake, our debt. We're going to get a return on our capital. So I think that's what's realistically going to happen. Deal breaker once again for me. I think there's other better plays over here. Looking at their actual growth rate, even if they hit these growth rates, I think the pressure on that leveraged balance sheet and the maturities is going to destroy the value of the growth going forward. And plus, you're incurring executional risk as well. All right. Price action and valuation. All right. As we close and digress, they're trading below one price to sales on a profitability metric that is barely profitable here with minor free cash flow profile. So if it weren't for the levered situation, I would say that they deserve to maybe trade at 1.5 times price to forward sales. That's just me. But with the I bet I assess that Mr. Market is, pricing them at these lower sales multiples due to the levered balance sheet and the whole situation. I hope you guys got value. Subscribe, thumbs up, follow along. I got more videos coming out. I hope everybody's been enjoying their holiday season thus far. I appreciate everybody's support. I love y'all and take care.